Hey everyone, and welcome to episode 1 of our 8-part explainer series on the machine. If you're tuning into this, it means you're ready to look past all that surface-level noise of the market and finally understand the actual underlying mechanics driving its direction. We're going to expose the hidden forces that make the tape behave exactly the way it does. We'll map out exactly who is sitting on the other side of your options trades and why their forced actions dictate whether the market just grinds sideways in a tight, boring range or suddenly cascades violently out of nowhere. Okay, let's dive into this. Here is our syllabus for today. First, we're covering Greeks as dealer forces. Second, the delta-hedging loop. Third, we'll see how positive gamma dampens markets. Fourth, how negative gamma amplifies markets. And finally, we'll wrap up with the specific rules for each regime.
Now, if you only remember one single sentence from this entire explainer, please make it this one. Dealers don't have opinions, they have inventory, and hedging that inventory is a forced, predictable flow. The market is not just some random walk of retail opinions. It's actually a highly mechanical reaction to inventory. Everything else we're going to talk about today stems directly from this one core truth.
All right, Section 1, Greeks as dealer forces, stripping away the textbook trivia. We are officially ditching those traditional retail definitions of Greeks, and we're focusing strictly on how they force a market maker's hand.
For retail traders, delta is usually just viewed as a probability, right? Like the odds of an option finishing in the money. But forget that for a second. For the dealer on the other side of your trade, delta is the exact amount of underlying stock or index futures they must hold to remain perfectly hedged. It is a strict mathematical mandate for their inventory size. If their delta risk changes, they must trade the underlying asset. No exceptions, period.
And naturally, that brings us to gamma. For the dealer, gamma dictates exactly how often and how hard they have to continuously rehedge that delta as prices move around. Gamma is the single most critical force we are looking at in this explainer. Why? Because it dictates the speed and the absolute violence of the market maker's reaction. It literally measures how fast their inventory mandate changes. Moving right along to Section 2, the delta-hedging loop. This is the real engine of market impact. We're going to look at what happens the exact millisecond your retail order gets filled. Let's say you buy a put on an index. When you do that, you're almost certainly trading against a market maker. The moment your order fills, the dealer is now short a put. Listen, they don't want your directional bet. They just want to collect the spread. So to neutralize their risk, they must immediately sell short the underlying asset in proportion to that put's delta. Do you see what just happened there? You bought a put, and the market immediately received actual sell-flow. Retail trades actually move the market, not because of trader opinions, but because the dealer is instantly forced to trade the underlying to hedge.
And this brilliantly illustrates the relentless mechanical cycle they are trapped in. Just walk through steps 1 through 4 with me. The customer trades, the dealer takes the other side and inherits the Greeks, the dealer hedges their delta by trading the underlying, and then, well, price moves. Step 5 is where the magic or the absolute destruction happens. Because price moved, the dealer's delta changes due to gamma. So what do? They have to rehedge, and they loop right back to step 4, forever. It's this step 5 that creates continuous, totally predictable market impact.
Okay, Section 3, positive gamma dampens markets. Think of this as the mean reversion machine. Let's look at what happens when the dealer book is net long optionality. In this specific regime, dealers are net long options, meaning they are long gamma. And because of this, their forced delta hedging behavior becomes entirely counter-trend. In this state, the machine basically acts as a giant dampener that actively suppresses market volatility. This is why realized volatility actually comes in below implied volatility. Here is exactly why it dampens everything. When the price rises, the dealer's delta grows way too long. To stay perfectly neutral, they're forced to sell right into that rally. Conversely, when the price falls, their delta drops too short, forcing them to buy right into the dip. So rallies are mechanically suppressed and dips are mechanically cushioned. The whole tape just feels sticky, magnetized, and honestly, pretty boring. So what are the actionable rules for you here? When you know for a fact you're in a positive gamma environment, you range trade the market. Fade those extremes toward the middle. Buy the dips near big support strikes and sell the rips near resistance. But most importantly, know that breakout trades face severe hedging headwinds. If you try to trade a breakout in this regime, you aren't fighting a narrative, you are fighting a literal machine that is strictly programmed to sell your breakout. Let's move to and see how this builds in Section 4. Negative gamma amplifies markets. This is the momentum accelerator.
So, when dealers are net short options, they are short gamma. This usually kicks in when customers have heavily bought downside puts. In this state, the dealer's forced delta hedging becomes violently with trend. This is the regime that enables those sudden air pockets, the cascade days, and those face-ripping short-covering rallies. Realized volatility now wildly exceeds implied volatility.
In negative gamma, when the price falls, the puts the dealers are short start to gain delta. To hedge that, the dealers are forced to sell more of the underlying right into the decline. And if the price rises, they are forced to buy aggressively into the rally. The hedging no longer cushions the market. It acts as pure rocket fuel. It forces trends to wildly overshoot.
To survive a negative gamma environment, you need some very strict rules. Rule number 1, do not fade moves. The machine is actively pushing them. Fading here is absolute financial suicide. Instead, you've got to let your winners run further than feels reasonable because these trends will extend. You need to widen your stops to survive all that amplified noise. And keep your eyes peeled for acceleration strikes below the market. Those are trapdoors, not support floors.
All right, bringing it home with Section 5, Rules for Each Regime, the playbook. Let's consolidate the numbers and the actionable logic so you're ready to trade.
So the crucial point really comes down to this contrast. Identifying the dealer inventory is step 1 of any trade you will ever make. If they're net long, the physics are dampened, the flow is counter-trend, and vol is suppressed. But if they're net short, the physics are amplified, the flow is with trend, and vol massively expands. The physics of the market literally change depending on which regime you are currently sitting in.
And when you cross over from that positive regime into the negative regime, this is the most important number you need to remember. 25 to 40%. This is the mandatory position size reduction you must take when the market crosses into negative gamma territory. A trade idea that worked beautifully yesterday now lives in a world where daily ranges can suddenly double. You literally have to reduce your size so you can accommodate wider stops. Now, this brings us to a vital question, one that shatters a really dangerous retail myth. What exactly does negative gamma predict? Because a lot of traders see dealers slip into short gamma and they immediately assume, oh, the market is going to crash.
Now, what's really interesting here is the reality check. Negative gamma predicts magnitude far better than it predicts direction. It totally guarantees that the moves will be violent and large. But remember those mechanics. A violent squeeze can easily rip upward just as fast as a cascade can dump downward. The machine amplifies in both directions.
As the source material bluntly notes, treat negative gamma as larger moves, unknown sign, and get your direction from other evidence. Seriously, do not blindly short just because dealers are in negative gamma territory. Use the gamma map to understand that the environment is highly volatile, but look to your other tools to find the actual vector of the trend. I want to leave you with this final provocative thought. When you place your next trade tomorrow morning, are you just betting on your own narrative and your own opinion? Or are you calculating and front-running the machine's forced inventory? Because guess what? The machine doesn't care about your opinion. It only cares about its hedge. Master the mechanics of that hedge, and the market stops looking random. Thanks for joining me, and I'll see you in episode 2 of this series, where we're going to learn exactly how to map these gamma levels in real time.